Recession-proof stocks 2022. The prevailing sentiment among Wall Street analysts these days is that a recession is coming. The market has been on a historic 9-year bull run after the Great Recession, punctuated by a run at the end of 2017 that saw new market highs being reached seemingly every day. But in investing, what comes up will go down. Fortunately, recessions do not have to be the death knell for stocks. In fact, there are several stocks that have a history of performing well even when the economy does not. So let's take a quick look at some of the companies who are positioned to help your portfolio not only survive, but thrive when the stock market does take its inevitable tumble. Welcome to Recession Preppers. Make sure to stay tuned till the end. Number 1. Walmart, WNT. Walmart is one of those companies that keeps it simple, advertising and delivering on everyday low prices. In robust economies, the retailer may be discounted by analysts as it finds its margin squeezed, but the company consistently shines during recessions. The company benefits from its chain of Sam's Club stores, which cater to consumers who buy in bulk. These stores tend to thrive as consumers look for the value of bulk purchases to make their dollars stretch. In the past year, Walmart has been actively increasing its e-commerce efforts in response to the popularity of Amazon, and analysts are seeing those efforts begin to pay off. A strong e-commerce presence would provide additional support for Walmart should the economy move into recession. In 2008, the company posted a 7.2% revenue gain and a stock price increase of 20%, beating the S&P 500 by 58.5%, and Walmart was one of the few companies to increase their dividend yield during 2008, despite warnings from Wall Street. This was particularly impressive since some businesses were cutting their dividends altogether. The current consensus opinion of analysts is a hold. Number 2. Pfizer, PFE. Pfizer is another one of those stocks that can find the going tough in a booming economy. Like many companies, its only offense in the short term is that it's not growing as fast as investors would like. They do have some questions about their pipeline of new products, and they had lost the exclusivity of their Viagra brand in December of 2017. All this has some analysts urging buyers to hold on this stock. However, a closer look at the analyst reports showed that the next largest block of analysts gave the stock a buy rating. Do they know something? Maybe. But if you're watching this, you're looking for stocks that should perform well in a recession. And there's little doubt that Pfizer can play that role very well. Consumers will need and want their products. And since bottoming out at the beginning of the Great Recession in 2009, the stock has been trending upward, albeit perhaps at a slower rate than its competitors. Number 3. Dollar Tree. It's hard not to love a stock that's quadrupled in value over the last decade. Still, Dollar Tree has been taking it on the chin lately. Their crime? Their growth is slower than expectations. This is indicative of companies like Dollar Tree that have a business model that caters to value-conscious consumers. When the economy is growing, consumers feel more comfortable doing all their shopping at full-price rivals, rather than splitting their shopping trips looking for bargains. However, when the economy starts to slow down, many of these shoppers return to Dollar Tree. After all, as the name implies, you can buy many items for just $1. Dollar Tree proved its mettle in the last recession, generating a 2008 return of 60.8%. which outpaced the S&P 500 by 99.3%. If there is an economic downturn, companies like Dollar Tree are well positioned because they are not as exposed to the e-commerce trend and, in fact, can offer some value that even those companies can't. Number 4. General Mills, GIS. General Mills is one of those stocks that can be owned in good times and bad. However, demand for their products tends to increase during recessions, largely because consumers will seek their products as they trim their entertainment budgets. General Mills stocks avoids the volatility that is typically associated with high-return stocks. Case in point, In the last 10 years, the stock of General Mills has an annualized standard deviation of 17%. And, like many companies on the list, General Mills is a dividend aristocrat, offering a dividend that has been steady or increasing for 115 years. This combination of low volatility and consistent dividend payments without a reduction is more in line with what you'd expect from a utility stock. However, this is a company that expects double-digit total returns. In fact, in the 20-year period from 1995 to 2015, General Mills averaged an 11% total return per year, beating the broader S&P 500, which averaged 9% per year. The stock is trading for an adjusted price-to-earnings ratio of 18.9, which could make it a nice bargain ahead of the next financial crisis. Number 5. Ross Stores. When the economy slows, buyers flee towards value. That's where companies like discount clothing retailer Ross Stores thrive. While already capturing the budget-minded shopper, the company has displayed proven performance among more affluent consumers when the economy slows. During the 2008 recession, the company added 66 stores, and by rewarding its shareholders with a 17.6% return in that time, it beat the S&P 500 average by 56%. In advance of their second quarter earnings announcement on August 16, analysts are projecting a 6.4% increase in year-over-year sales. The consensus rating on Ross Stores is a buy, with stock prices forecast to increase up to 0.7%. Investors also look for the relative security of dividend stocks during recessions. Ross Stores pays an annual dividend of 0.90 cents per share, with a current dividend yield of 1.04%. The company has increased its dividend every year for the last 11 years, at an average of 17% each year, making it a great potential source of income during the next downturn. Number 6. Johnson & Johnson. It's almost too easy to talk about Johnson & Johnson's status as a dividend aristocrat. As a reason, this stock should be in your portfolio during a recession, but it's hard to overstate. J&J is one of the only 19 companies that can say they have offered 50 consecutive years of dividend growth. That's a long time, and it shows no sign of ending. This is because of a well-diversified portfolio, both in terms of the products they provide and the markets in which those products are sold. They offer brands that are literally household names, such as Neutrogena and Listerine. The company has 3 operating segments that are proven to weather economic headwinds: pharmaceuticals, medical devices, and consumer health. Normally, having diversification over several segments allows 1 or 2 units to pick up the slack when others underperform. In the case of J&J, all their business units continue to make a profit, allowing the company to generate significant cash flow, which should allow them to continue to issue a healthy dividend, making this stock very attractive to investors. That's it for the video. Feel free to share your opinions in the comments below, and don't forget to hit the like button, subscribe to the channel, and press the bell icon to stay updated about our next video.